Hello everybody. So a few weeks ago when I hit 200 subscribers, I offered for you guys to suggest stocks for me to review, to check out, and this is gonna be this video. And it took me 3 weeks to get to it. At first I was waiting for more replies, then kind of life got in the way. It really took me a while to get here. So apologies for that. And just to give a quick life update, I kind of feel like sharing. My family travels full time. We're leading a nomadic lifestyle. We retired early. Our two boys, they're still small. They're homeschooled, like unschooled, and we're traveling full time. And then, as you can see, my setting hasn't changed for a few videos now because we're in Slovenia in Europe, and we really like it here. We're gonna stay here for 2 more months, so this is gonna be my setting for at least at least 2 months more. And we're thinking about staying here. We're thinking about hitting our roots here, and we really like it here. But on the other hand, we love the nomadic lifestyle also, and we kind of it took us a while to get there. We kind of don't want to lose it also. So yeah, we've been debating a lot about it recently, and this is kind of where my mental resources have been in the past few weeks. So I was still doing the investment and the YouTube thing, but like kind of more on a low key. But I do have a huge backlog of videos and updates that I want to do. I think we're gonna make a decision soon, and then I will be free in my mind for to continue for with building up my portfolio. And then I have a huge backlog of ideas and videos I want to make, and I'm gonna be more available, mentally available for this. So I have a few stocks that I'm selling for profit now, and I have a few stocks that I want to buy. I'm gonna research them, and I hope there will be some nice opportunities there. And I want to share my entire portfolio, which has already kind of changed since I shared my dividend portfolio, but also all the rest of my stocks, just my entire portfolio. And I actually finished deploying all the cash. I was sitting on a lot of cash until I began this journey now. The YouTube thing is really helping me to stay consistent also. That was my first goal with it. And I didn't finish to deploy all my cash, so now I have a full working portfolio. So I really wanna begin to track my performance from now on. So I wanna make a video about it and begin to sharing my performance. Obviously, it's gonna take a while until we see results, but just to share how I'm gonna do it, and just to mark the beginning of it. So yeah, I have a lot of videos coming up. I have a really big backlog of videos I want to do. So I hope I'm gonna get to it in the next few weeks. So stay tuned. There's a lot of coming up. But today let's talk about it was a long intro, I'm sorry. So today let's get to the stocks that you guys requested. It's obviously not gonna be a deep research about every company. I didn't do a deep research. We're gonna check out them kind of superficially, kind of briefly, and whichever stock looks like a good opportunity, like something interesting for me, maybe personally, I'm gonna set it aside and check it out separately and do a deeper dive and maybe a deeper research about it and share it in a separate video later on. So let's begin. So the first tag that was requested, replied to my post, was by Garfield J83, Texas Roadhouse, ticker symbol TXRH. A very interesting company. It is a restaurant food chain. It has a few brands, the Texas Roadhouse, Baba 33, and Jaggers, all over the United States. It looks really interesting. Let's look a little bit on the financials and the growth. So we can already see that the stock is overvalued a little bit. The price is pretty up right now, but we can see it has a really nice track record of growing the revenues. The blue bars are the revenues over the years, and also the EBITDA and also the net income. Obviously, it had all those shutdowns during COVID has affected it, but except that, a really nice track record of growth in every possible metric. It has a debt of 800 million while having a cash flow of about 200 and a half, to 250 million, which is 4 times as a manageable debt. It's okay in today's days. Really a nice and consistent return on invested capital of above 10%, around 10%. It has been buying back shares once in a while. It has a dividend. I have it here, dividend yield of around 1.2, 1.7, I think. Yeah, here it's gonna be 1.7, never mind. So it looks really interesting. Let's look at fast graphs. So this is the Texas Roadhouse. Really looks like a nice company. The only thing I would say about it is it's obviously overvalued at the moment, with a PE of 31. It is growing this year. Earnings are expected to grow 40%, and then like a long-term expected growth of 12%, which might materialize, I might not, and that's beginning to be my symbol, my theme on this channel, that growth is not guaranteed, and I have been really severely burned by cases where growth has suddenly stopped, and what would happen then to the multiple and to the valuation of the company if earnings are expected to be even flat suddenly for next few years. I don't know how plausible it is for a company like a Texas Roadhouse, which managed to grow even in a financial recession, it seems. Although in 2008 it did have flat earnings, but it was only for 1 year, and except that it grew really nicely, but it was obviously many years ago, and it doesn't mean it's still in the same phase of growth today. So it might not be again like that in the next recession, but overall it does seem like a pretty resilient, recession resilient company. But again, very, very richly priced at the moment, it seems like. Let's look at the basic earnings. Also, very nice. I like that it's a similar story to the non-GAAP EPS also. Let's look at cash flow. Also, really nice growth. And by every metric, we see that currently the price is really high up there. Yeah, let's look at the free cash flow. Also, we see a very high valuation of almost 40 times the free cash flow. So it looks really, really nice. I'm adding it to my tracked companies, to a list of companies, of target companies I have, and I track them. And when the price goes, if and when there is a better opportunity, entry opportunity to this company, I would love to own it for the right price. It would probably be somewhere around okay, this is 15 PE. I understand that with this high growth, it's worth more than 15 times the earnings. But right now, 31, I think it's really rich. And how much upside can it have from this price? So for me, I'm gonna probably maybe if it goes back to here or here, I'm gonna look at it again, but I would probably decide that it's still too expensive for me. So maybe in a multiple of, I don't know, 17, let's add it. Maybe a 17, I would be willing to start a position. So maybe in the price of around 121, maybe a little bit above it, maybe 140. That would be a price that would be interesting for me. But a really, really interesting company. It looks very nicely managed, and the growth. And here we see the dividend. They started paying a dividend in 2011, and they have been increasing it since then, except of course it's not a bump, it was a crazy situation in 2020. So of course it's a really black swan event and completely understandable, but except that they have been increasing their dividend. They reinstated it back to previous levels right after 2020, when COVID was still raging on. So it looks really, really nice, very interesting. Just for me, too expensive. I think there is not much of an upside from this price. There is really room for a correction here, unless they suddenly, I don't know, grow. They will surprise and grow for 40% for a few years and kind of earn into this valuation. It has to come down a little bit, and then I would be really interested in looking at it again and give an update if this happens. So that's Texas Roadhouse. The second stock that was suggested in my post was by V Patel 3989, GFF. So GFF is a Griffin Corporation, and it's a building materials company. Let's look a little bit at what they do. Griffin Corporation, through its subsidiaries, provides consumer, professional, and home and building products in the United States, Europe, Canada, Australia, and internationally. The company operates through two segments: home building and building products, and consumer and professional products. The home and building product segment manufactures and markets residential and commercial sectional garage doors, rolling steel service doors, fire doors, shutters, steel security grills, and room dividers for the use of commercial and construction and repair and home remodeling application. The segment also sells the consumer and professional products segments manufactures and markets long handled engineered tools, including spades, shovels, two spades. It's meaningful. Scoops, rakes, hoes, cultivators, weeders, post hole. Okay, so we get it. Like all kind of building materials for homes. So if we look at GFF, Griffin Corporation, let's look a little bit at the market cap. How big is it? 3.5 billion in market cap. So let's look at the financials at first, and then talk a little bit about the industry and just the environment a little bit. So just to look at, am I in GFF? Yes, I am. Okay. It looks also expensive. So we see that it has kind of a growth a little bit in recent years, but overall there is not a consistent growth story here, and it's not consistent, and we'll talk about it in a minute, what effect might be affecting it. We see that in EBITDA they had really a nice 2 past years, but except that I don't know, and then net income is really inconsistent. We see, I think, very high debt, 1.7 billion dollars in debt, on a cash flow of around 300 million, which was really elevated in the past 2 years also, but before that it was really below even 100 million. So it's really high debt. So we really see an uptick in its performance, in its revenues and earnings and cash flows in the past 2 years. So it's gonna be interesting to check why. Yeah, but for me, it's just not type of company that I would be interested in. And I'm not saying it's a totally bad investment for anyone. It's just not exactly for me, because historically, its performance has been not that stellar and very inconsistent, and it just had those last 2 years where everything has suddenly looking good now, and there is a growth expected and really stability kind of in its performance in all its metrics. But historically, we see that there has been really inconsistencies with its performance, with its earnings, with its revenues, with its cash flows also. And I don't know, for me, a few things. First of all, by the way, another video that I want to do, another video in my backlog, are more investment mistakes that I think I did with my growth stocks. And one of the biggest was that taking companies with not enough a good track record of history of performance. I mean, not in the stock price, and I mean in its financial performance. And this is exactly it. I mean, right now maybe some good things are going on for the company, and there are good projections and good optimism with the company, but it's just for the past few years. But before that, we can see that again the performance was really inconsistent, and that's just thing that I'm personally kind of staying away from, avoiding right now. And also in its return on invested capital, we can also see it's been really low until those last 2-3 years. So that's the first thing that kind of keeps me away from the stock. The second thing is the debt, the high debt, the below investment grade credit rating. And the third thing is just I don't know, building materials. First of all, it's not an area of expertise for me, and I think it should be if for whoever invests in something that has to do with real estate. It's crucial to understand all the macroeconomic and external factors that would be affecting the performance of the company, more even than the internal decisions that the company is making in terms of interest rates and the amount of homes being built and the prices of homes, new homes. So it's gonna be really important, and that would probably be the things that would most affect the performance of the company. Again, without researching, that's just my gut feeling. Maybe I'm wrong here, but the reason I usually avoid companies like that exactly because of this. Because I don't like to bet on those external macro factors because I cannot account for them, and it's very, very hard to predict. The truth is that usually nobody knows what the trend is gonna be like in the prices of homes, or how many homes are gonna be built, and it's gonna be really affected by the economy, which of course all our portfolios, no matter how we build them, are gonna be affected by the economy. But to have this direct exposure to those really very specific, very direct, again, effects of prices of homes and interest rates and all of that, I don't personally like, because I cannot predict it. Again, if anybody has a specific insight about things that are going on with this company, or even better, maybe a specific insight, a specific bet they want to place on exactly those external factors that I think, for example, I think interest rates are going to go down, and then even more homes are going to be built, and then this company stands to really profit from it. Fine, okay, I don't like to bet on those things, so it's just not for me. So that would be the big maybe reason that I would have avoided. But also the not so consistent and the not so impressive track record of performance. Again, if we look here, for example, the basic earnings, the gap earnings, and again, the below investment grade, very high debt, kind of a risky, not very high quality company, it seems to me. So that's about Griffin. So the next requested stocks were a reply to my Pfizer video, where I gave a nudge to suggest stocks, are VEOEY and HPE. So VEOEY is Veolia Environnement company. It is a French multi-utility company. I kind of tried to do a little bit of a deeper dive into it, and it's kind of a little bit hard to understand what exactly they do and how exactly what are they affected by. But overall, this is a company into waste energy and water management. So kind of a multi-utility, a French company. It looks really interesting, to be honest. If we look here, Wolf Report, the only guy I used to like on Seeking Alpha is recommended it. If we look into it, it really looks interesting. Let's look at fast graphs. So we see that it had a really huge problem, it seems, for many years since the Great Financial Recession. I don't know if it was related to it until 2012, and since then it would be really interesting. I mean, I want to do a deeper dive into it. It's interesting, but since then, if we kind of take out this, I don't know what happened until then and what changed since then, and how today it's gonna be different, and that's what we need to check. But since then, it seems like the company has been growing really impressively. It looks very interesting, and in terms of price, it also looks very interesting, and almost to the point where I suspect there might be a good reason for it. So it's something that really we should check. But overall, we see, as a European company, we see that the dividend is not very consistent, like with many European companies. But currently, the dividend yield here, FastGraph says 3.46, but in Seeking Alpha, which I believe more, is a 4.6 dividend yield, which is pretty high. So if we look at a little bit at the financials of Veolia, we can see that in terms of revenues, it did have a pretty stable revenues until the last few years, when it has again an uptick in revenues. But we saw how in net income the story is a little bit different, or in adjusted EPS also, what we looked at, and we're going to look at other metrics in fast graphs in a minute. It has a really high debt, obviously a utility, 22 billion in debt on a cash flow of around 3.5 billion is rich. It's really rich, but again, a utility, kind of normal for utilities, I guess. Still high. It doesn't mean I like it. Return on invested capital is at least consistently around 3-4%, but obviously it's low. But again, utility, very capital intensive business, so the return on invested capital, which is the invested capital, is a lot, the return is gonna be always less. It's not exactly the company that would give you stellar returns. It might be more of like a safe investment for the dividend, but I don't know how safe is the dividend. I mean, it doesn't look safe, it doesn't look consistent. But what does look interesting for me is if we look at other metrics, this is the basic earnings. So we see a different story, which again I don't like, and I would check that to see what's behind it. And this is projected. So when we see the estimated EPS in the fast graphs in basic earnings, it's usually gonna be the non-GAAP EPS. So after it does materialize, after we get here in the quarter, it's gonna be probably again low. But it seems like what the metric to look at, and the best indicator would be the operating cash flow, where we can also see that the price is really tracking it nicely, and we do see consistent operating cash flow, and that's what really got me interested in this opportunity. Again, I will be checking what happened here until 2012, but if again we take this out of our range and look here, we see that the company is really nicely tracking around the multiple of 5 of operating cash flow, and currently it does seem like a cool opportunity with about 50% potential upside, with a dividend yield which is currently around 3.4 to 4.4%, but we see that it is inconsistent, so I wouldn't count too much on it. I mean, we probably will still see some kind of a dividend out of it, even when it has a lower dividend. It's still around here 1.6 3%, so 2%, 4%. So even if the dividend is not consistent and will be reduced, it's still a nice dividend. I mean, it's still a dividend, but the upside here really looks interesting, so I will be checking this one out. I wouldn't say it looks like the best opportunity for me, because again, this the track record here, I mean, I'm gonna check it and see how does it scare me that something like this could happen again. And then we see the credit rating of BBB, again very high debt, so maybe not the best, and we see this again discrepancy between the GAAP and the non-GAAP earnings, which I would also be curious to look at, but the truth is that probably the price would continue to track this blue line in terms of the operating cash flow, so it does look interesting, and I'm gonna do a deeper dive into this one. I'm adding it to my stocks to check and do a separate video about, so that really looks interesting. So that's Veolia, and the second stock in this comment was HP. So with HP, I don't know, I think for whoever is a dividend growth investor, also the dividend has been flat for a few years, so I'm not sure even for dividend growth investors it's a good opportunity. But for me, it's definitely kind of underwhelming. I can say there's something necessarily very wrong with it, but there's nothing, I don't see any kind of a special opportunity here also. First of all, right now it's a bit on a higher price. It's not nothing really severe, but overall, I mean, there is a kind of a growth here, but I'm not sure. I'm not sure it's really there. Let's look at the revenues. In terms of revenues, we see that there hasn't been a growth recently, really. And in terms of EBITDA, also, it almost looks like a different company from when I look at the fast graphs. Very weird. Let's look at the basic earnings. So does that even match what we see here? I don't know. Very weird. We see a lot here, and yeah, we see it here also. Okay, it looks different. It looks like a different story. I don't know. But yeah, overall, there's nothing stellar here. This is basic earnings. I mean, GAAP earnings. Kind of high debt of 13 billion. On again. Let's just clean it up a little bit. On a cash flow of 1.6, 1.4, 3 billion, very high. It seems very high. Very unimpressive return on invested capital. There's nothing attractive for me in this company. Again, the dividend was, if someone is interested in the dividend, I don't think it has enough of a track record, and it seems like it wasn't growing here. Yeah, it was frozen for a few years. So I don't see any opportunity here, nothing that attracts me. If we look at the cash flow, also, like, there is maybe some kind of a growth trend here, but it's very inconsistent. Let's look a little bit maybe in I like to look here sometimes in Guru Focus. So those are the revenues. If we look, like, I don't know, there's just not a trend line here. This is the EPS. This is the EBIT, the EBITDA, the cash flow. Nothing that I see that has really showing me some kind of a trend or some kind of a growth. So I don't know. It's just I don't see any. I mean, I would love to hear maybe a suggestion. Why would that be a nice opportunity? Like, just looking at it like that, it doesn't seem like it. And in addition to that, I will add that HP, and I'm a pretty technological girl. But when I did work, I worked in IT, so I kind of a little bit know my IT. And still, when I look at what HP does, and trying to just kind of calculate in my head what that means and what kind of a sector is it? Is it safe? What are the trends in it? What does it have a moat? Doesn't have a moat? How strong is it? A competitive advantage? How I don't know, the competitive landscape. I mean, for me, it's impossible, honestly. And again, I kind of a little bit. Of course, I had my niche and I don't know everything. But again, I come from this field. And for me, it's very hard to understand and to project. I think it would be almost comical to read this company description, which I think very, very, very few people know what all those things mean. And even if they understand what the HPE nonstop and HPE integrity products and the HPE Cray XD and I don't know, HPE as meal software container platform means, they won't know what other things here mean. But even things that I do know, like I don't know, Wi-Fi access points, switches, and gateways, which I understand a little bit. Yeah, HP have been strong in this field for years, but maybe that's would be the main reason here why Warren Buffett has never, not never, but traditionally avoided technological stocks. That would be a perfect example where you don't know where HP's competitive advantage, moat, and market share it would be, even in the things that you do understand here. So By the way, if I look or sound sick in this video, it's because I am. I am sick. The whole family is sick, and I'm having a little bit of a hard time just talking fluently. But it's okay. I will prevail. So yeah. So I don't know. For me, it's very hard. In addition to not anything that I don't see anything impressive. It's a bit underwhelming in the financial performance, in all the metrics, in all the numbers. Also, understanding the business prospects of HP, I think, is very, very difficult. I think my guess would be that it would be even difficult for people who it is their area of expertise and area of competence. Again, because it's very unpredictable. There is so much here. So yeah, I don't know. So I don't know. Just HP is just not for me in terms of the business and the financials. So kind of brief one on HPE. And the last stock for today would be Carrier Global, suggested here by Luis Hernandez. So Carrier Global is also a building products company. Let's look at it for a minute at what it does. Yeah, refrigerator, fire, security, building, automation, technologies in the United States. 3 segments: refrigeration, fire, and security. Okay, so it's not exactly like building materials, but I don't know if my problem with it already right off the bat that it has IPO'd in 2020, so it doesn't have enough of a history for me to understand like its performance over the years. Again, me understanding that one of my biggest investment mistakes in the past have been investing in companies with not enough track record, when I couldn't really understand how the company would perform in a bad environment, in a kind of a more difficult macro environment, or just overall that it, not even only, just to see that its growth is sustainable over the years, or even if it doesn't grow, that it's flattish earnings and the cash flows are sustainable over the years. And for me, I'm from now on, I'm avoiding companies that have not been public long enough for me to understand their history well, because I think it really, I used to think that past performance says nothing about future performance, but now I think it says a lot. Of course, it doesn't guarantee anything, but I think a company that has a proven long track record of kind of some kind of sustainability and predictability, it is really, for me, has become one of the most important factors to look at. And with this company, I don't know, I mean, it's just not enough information. If we look at its financials, I'm sorry, I sound so sick, it's getting worse as I record this video. We see, yeah, the revenues, there is a slight trend of growth here, but yeah, in terms of EBITDA and the net income, we'll look at fast graphs in a minute. And I don't know, I mean, it's very hard to account for when there is not enough history. 15 billion of debt, cash flow of around 1.5 to 2 billion. So again, very high debt. Return on invested capital looks impressive. It's actually kind of interesting, but yeah, I don't know. It's just not something I would be interested in. Let's look a little bit at the other metrics. So this is basic earnings. Oh, and one of the important things I forgot to mention, that it looks really expensive right now. The PE is 30, and we can see that even historically, I mean, it doesn't have a lot of history, but it's at a higher price now. And yeah, they forecast a growth of 20% and 15% in the future, but for now, the earnings are declining this year and 8%. So for a company that is currently on a decline, to trade a 30 PE, it's really kind of built on hopes that things will recover, probably due to macroeconomy, probably because I see it all the time. And I have stocks like this, and it's really a pain to wait for this recovery. And estimate, the thing is that analysts, because they expect this long-term growth, they will always project it starting next year. But as long as the macroeconomy remains tough, it's gonna be underperforming for, it could be 3 years, it could be 5 years, as long as it takes. So I wouldn't take those projections too seriously. Again, it means that overall analysts are estimating for the company to resume a nice growth once the macroeconomy does recover, but that's now. And if the macroeconomy does not recover for a few years, things might really change for the company where it doesn't resume this growth, even if you wait all those years. So I would be really, really careful with it. And I'm speaking from experience because I have been burned by it. So if we look at cash flow, also it looks this year's cash flows are gonna be low, but it looks like just a one-time thing. But even if not, it does look expensive compared to cash flow. Also, free cash flow. I like that the story is similar to operating cash flow, but it looks both expensive and not enough history, very high debt. So not something I would be interested in. Again, I'm not saying it's for sure a bad investment and it won't fit anyone. If someone has a specific, all the stocks I mentioned today, if someone has a specific thesis for it, why they think that it's a good opportunity, it might be a good opportunity, just not for me. So yeah, so out of all the stocks I looked at today, Veolia looks the most interesting one, and I will do a video about. It's not the best, but it looks very interesting when we look at operating cash flow again. So I'm adding it to, I have a few stocks I want to research before that, and I will make a video about them first, and then I will get to this one and we'll make a separate video about. So yeah, so it's been really interesting. We might do it again in the future. It's nice. I was actually thinking about one day to do a live session of research and stocks like that. Maybe that would be interesting. Maybe when I have more subscribers and more people will tune in, it would be kind of cool and interesting. So I have a lot of ideas, and as I said, I have a lot of videos coming up. I have so many ideas, I didn't even mention all of them. So I kind of hope to make more than one video a week in the next few weeks, and to just kind of up my pace a little bit. And because I have so much to share, honestly, I hope I will be able and have the spare time and the ability and the power to make more videos in the next few weeks. So yeah, there's a lot of coming up, and stay tuned, and I'll see you in the next one. Bye bye.